5 tax changes for 2026 that affluent families should know. A married couple can earn over $435,000 this year and still be in the 24% tax bracket. That's not a typo, and it might be the most important number in the entire 2026 tax code. But here's the thing, that number probably won't last forever. And if you don't know it exists, you probably can't take advantage of it. Today, we're breaking down the 2026 tax changes that actually matter for you and your family, and the ones you can safely ignore.
This video is for educational purposes only. Always consult professionals before making legal, tax, and investment decisions. Every year, new tax rules make headlines. There are new deductions, new credits, new write-offs. And every year, the same thing happens. The headlines focus on changes that sound exciting, but don't actually move the needle for most families earning $150,000 or more. This year's no exception. There are provisions for tip earners. There are expanded deductions for overtime workers. And those might be meaningful for certain people, but they're probably not meaningful for you. So instead of walking through every change, we're going to focus on the ones that could actually affect your tax situation. And more importantly, the ones that create real planning opportunities.
Let's start with the biggest one. The tax brackets have been adjusted for inflation. That happens every year. But here's what most people don't realize about the current bracket structure. Right now, a married couple filing jointly can earn roughly $435,000, including the standard deduction, and still be in the 24% bracket. That's a historically wide bracket. What people don't realize is that the Tax Cuts and Jobs Act dramatically expanded the 22% and the 24% brackets, and most people have no idea how much room that actually gives them.
And that matters because of what you can do inside that room. If your household income is, say, $250,000, you've got significant space between where you are and where the 32% bracket starts. That space is a planning window, and one of the most powerful things you can do with it is convert money from a traditional IRA into a Roth IRA, paying taxes now at 24% instead of later at whatever that rate might be. We believe taxes are on sale right now. The government is running record deficits and carrying over $40 trillion in debt. At some points, rates are going to have to go up. And when they do, the window closes.
Now, here's something that's actually new this year and directly affects higher earners. If you earn more than $145,000 last year, any catch-up contributions you make to your 401k or 403b, that's the extra amount the government allows you when you're 50 or older. They now have to go into a Roth, not traditional, Roth. That means you're paying the taxes this year. And on the surface, it might feel like a penalty, but think about it differently for a second. The government is essentially forcing you to do something that might actually be in your best interest. Paying taxes now at today's lower rates and letting that money grow tax-free for the rest of your life.
There's also a new super catch-up provision. If you're between the ages of 60 and 63, you can contribute an additional $3,250 on top of the regular catch-up amount into your retirement plan. I know it's a narrow window, just those 4 years, but it's extra money you can shelter. And the contribution limits across the board have gone up. The 401k limit for employees under 50 is $23,500. IRA and Roth limits are up to $7,500. Not dramatic changes, but if you're not maxing out, or if you didn't realize you could fund an IRA from an investment portfolio and not just your paycheck, it's worth a conversation.
If this is the kind of information that makes you think differently about your tax situation, hit subscribe. This channel isn't about chasing headlines. It's about the strategies that actually move the needle for families like yours. Now let's talk about the SALT deduction, state and local taxes. If you live in a high income tax state, this matters. The old cap was $10,000. The new cap is $40,400. Now that sounds like a huge jump, and for certain families it certainly is. It could mean a significantly larger itemized deduction, but there are income limits. If your modified adjusted gross income is over about $505,000 for a married couple, that deduction starts to phase out. And in 2029, it sunsets entirely. So is this helpful? For some families, absolutely. Is it a game changer? Probably not. It's one piece of a much bigger puzzle.
So here's one that doesn't get enough attention: the RMD age, the age when the government requires you to start taking money out of your retirement accounts. Right now it's 73, it's eventually going to 75. And most people hear that and think, great, I can leave my money alone longer. But we'd encourage you to think about it from a different angle. Ask yourself, why would the government give you permission to leave more money in a tax deferred account for a longer period of time?
They're not doing it to be generous. Every year you delay, that balance grows. And when you finally do start taking distributions, or when your kids inherit that account, the tax bill's bigger. That's a bigger number for the government to collect. So the smart move isn't necessarily to wait just because you can. It's to look at your situation and ask, does this make sense to start pulling money out strategically, even before you're required, when you're in a lower tax bracket? Yeah, that's tax planning. And it's the opposite of what most people do, which is wait until the government tells them they have to.
And this brings us to the most important thing we can share with you today. Everything we just talked about, the bracket structure, the Roth rules, the SALT changes, the RMD timing, none of it matters in isolation. What matters is how these pieces fit together for your specific situation. Here's what we mean by that. Your tax outcome isn't driven by any single deduction. It's driven by the structure, specifically the type of income you have and when you recognize it. Wages, interest, short-term gains, all taxed as ordinary income. Long-term capital gains and qualified dividends, they're taxed at a lower rate. Money sitting in your IRA and tax-deferred annuities, you haven't paid taxes on that yet. And when it comes out as ordinary income, even if the underlying investment was a stock that grew for 20 years. And then there's tax-free income, which are Roth distributions, municipal bond interest, and certain life insurance withdrawals. Zero tax.
When you can understand these four buckets, you start to see the real opportunity. It's not about chasing deductions. Deductions are a dollar for dollar offset for money you've already spent. You have to give someone $1 to get a deduction for $1. That's not a strategy, it's just a receipt. The real strategy is deciding which bucket to pull from, when to pull from it, and how to fill up the lowest tax brackets every single year. That's how you lower your lifetime income tax bill. Not by reacting to what changed this year, but by planning across the next 5, 10, 15, or even 20 years.
We had a client recently who was moving into a continuing care retirement community. The buy-in was substantial, but a significant portion of it qualified as a medical expense deduction. That one move created a planning window where it made sense to accelerate income, take strategic Roth conversions, and offset the taxes with that medical deduction. That's not a move you make because you read about a new tax rule. That's a move you make because someone is looking at your entire financial picture and asking, what's the smartest combination of decisions we can make this year?
One more thing, and this might be the most important point of all. You're going to hear the word permanent a lot when people talk about these tax changes. The tax cuts have been made permanent. The brackets are permanent. The estate tax limits are permanent. Here's what permanent actually means in tax law until the next administration changes it. That's it. A future Congress could look at the $40 trillion in debt and decide those rates are too low. And if that happens, every dollar you left sitting in a tax-deferred account just became more expensive to access. So when someone tells you the tax cuts are permanent, smile and nod, and then plan as if they're not.
So what should you do right now? First, understand where your untaxed dollars are. Your 401k, your traditional IRA, your tax-deferred annuities. Those are all dollars the government hasn't collected on yet. Know the number. Second, run a mid-year tax projection. Figure out what tax bracket you're going to be in this year and how much room you have before the next bracket. Third, evaluate whether Roth conversions or shifting future contribution to the Roth makes sense for your situation. And fourth, and this is the one that ties it all together, think beyond this year. The tax laws are always going to change, but the families who benefit the most aren't the ones that know every rule. They're the ones with a coordinated strategy to manage their lifetime tax bill. And if you're watching this and thinking, I should probably have a conversation with someone who can look at my specific numbers, we'd be happy to talk. There's a link below to schedule a conversation with our team. No pressure, no sales pitch, just a chance to see where you stand.
If you're starting to see that tax planning is about a lot more than what changes in any given year, you're right. And we've put together a deeper breakdown of how to actually build a strategy that lowers your family's tax bill over your entire lifetimes, not just this April. Because investing is the easy part. It's the tax planning built around it that's difficult. Click here to watch it now.